let's go through your numbers first of all. Haven't seen profits like this for 4 years, but for some reason the analysts didn't quite get it right, did they?
I think the profit that you were referring to there in the build-up is the underlying attributable profit. We're obliged to lead with that because of accounting regulations, but there's a lot of accounting funnies in that. I'd rather we look at something like the net operating cash flow, which is 10% up year on year at $18.5 billion and 5% ahead of analyst expectations. And I think that shows the strength of our performance. Another way of looking at it is our EBITDA margin is now 55%. Which is the highest it's been since 2011, which was the peak of the last boom, and when prices were 70% higher than they are today. And so that shows, I think, we've created a company that can sustainably now deliver a much higher margin through portfolio simplification and a massive delivery of productivity.
Andrew, of course, you would I would say highlight the bits of the report which, of course, are complementary. But let's just get a view as to where that increase in cash flow is coming from. So whereabouts?
Well, it's a mixture of us running our operations better and slightly healthier prices, which, when combined, give us these very strong margins.
So let's just have a look at these the prices out there for commodities
You're
here,
welcome.
And how you actually give forward guidance. What is your view of what happens this year? Is the performance that you've just had going to be can you repeat it? That's the thing, given trade tensions, on top of that, huge currency volatility as well.
Well, the way we give forward guidance is we look at how our numbers will turn out relative to, say, past prices and what were our current spot prices. And what we've said in this year, we expect to deliver $9 billion of free cash flow at current spot prices. Of course, the year just closed. We delivered $12.5 billion of free cash flow. And the year before that, we did $12 billion of free cash flow. So that's 12, then 12.5, and then 9, plus we will have $11 billion coming back from the proceeds of shale. So you have a company now that is actually throwing off in excess of $1 billion of cash every month.
Yeah, the thing is, are you seeing any slowdown in China? We were talking to Elizabeth Gaines, of course, the boss at Fortescue Metals, and she was saying that actually when it comes to steel, the Chinese market is doing fantastic for them. And so are reports of this slowdown in China hugely misguided?
Well, we're not seeing any slowdown in China. Perhaps a little bit in copper, but other than that, everything is going well. Obviously, the concerns that we have looking forward is that if this protectionism does take hold, it will have a dampening effect on the global economy, and that ultimately will affect the BHP. But we do expect that China will mitigate some of the impacts that it faces. Of course, we don't just sell to China. It will do more to stimulate domestic demand. And as we've been reading this week, it's going to work harder to actually encourage exporters. And from what I learned from talking to trade ministers around the world, there's a lot of countries in the world now that want to trade more with each other, and now that it looks that the US wants to trade less with them. And China will absolutely walk into that area and look to seek to find exports with other people. So we don't think the impact on China, even if some of these trade issues become very real, is going to be that significant in the short to medium term. But of course, we worry about protectionism generally because it's bad for growth in the global economy.
Generally speaking, we've seen stability in quite high prices, historically speaking, for commodities. Copper, though, I think since the end of May is down something like 19%. How does that affect you?
Well, we're a big copper producer. We run the largest copper operation in the world, and so of course it has an impact on the top line of those operations. But we know we face volatility, and that's why we as a company have majored in trying to drive our costs down. We'll always have to sort of work against geological factors like falling grade, rising strip ratio, which is the ratio of waste to ore. And of course we see a little bit of input inflation, and we try and quench all that through becoming more innovative, more technically adept, by continuing to advance the culture of our workforce, and we've done that very successfully. And that's why we have the same margins today that we had in 2011 when prices were 70% higher.
Right, now you've made this $11 billion exit from shale in the US and other things there as well. You're lifting dividends at the same time. Couldn't you use that money perhaps, I know if you did, you'd be damned if you do and damned if you don't, but couldn't you use that money more for expanding some of your other parts of your business as well? And I'm talking here about conventional, perhaps oil production or further growth in copper.
Well, we are using money to expand our current production. Our volumes are up 8% year on year. We have 9 significant projects underway. We have a major exploration program. We've told the market we're not going to spend more than $8 billion for the next year or so, year or two. We continue to improve the efficiency of our capital. So we're doing everything with our cash. We're investing in the future of our business. We've taken our debt down to levels which it's now at the low level of our target range, so we don't need to put any more on the balance sheet. And that means that the excess, and there's a large excess, can now find its way directly into the shareholders' pockets. But there has been money left over to grow the company in the future, and there's lots more to come. We have a cupboard full of options for the short and medium and long term in all our commodities. Of course, that they have to compete for capital, and we have a very strong capital allocation framework, which keeps us to that discipline. I mean, this is a company that's absolutely committed to strong cash generation, real discipline around capital, and then targeting rising value for the company and rising returns. And our returns this year are now up above 14%. If you exclude shale, which is going, it will be at 18%. And at current prices, we're targeting by 2022 to get up to 20% and add another 40% to the value of our company.
So when you say that you'd be using that money for future growth, are we talking inorganic growth or would it be organic? Ultimately, would you be on the M&A trail, even though, as some people say, there's nothing really out there at the moment that would interest them on a big-ticket item basis? I think the chairman was saying that.
Yeah, no, this is all organic growth. As a result of the work we've done, I believe we have a close to an ideal portfolio. We have access now to some of the best ore bodies on Earth, and I'm a geologist. We don't need to go anywhere else. As we've recently been talking, we understand geopolitics, so we think they're in the right locations, that they can be expandable. With the geology, they can be expandable. We're exploring in some of the best exploration fairways in the world for oil and for copper, which is where we want to add things. So we don't need to do any M&A in order to grow our business significantly. It's all organic.
Andrew, I know you've got to go. A quick word on Malcolm Turnbull and the political situation in Australia at the moment. Have you got some clarity, at least, very quickly?
I don't really have much clarity. I've been busy this morning with our results presentations. I've just heard about some of those things. The reality is that, like commodity prices, politics is a volatile business. We as a company are very able to cope with volatile situations and work through it in order to deliver a stable set of sustainable growing returns based on growing productivity, as today's results show.